Well, the market is not looking good at the moment, especially in this last week. We've just seen a lot more weakness. And today, what I want to walk you through is hedges that I'm planning for the coming week, should certain criteria be met. And I also want to walk you through the exact hedge, the position sizing, and when to actually trigger it in the market. So, the first thing to do is let's take a look at the SPY chart and see exactly what's going on. Now, as we can see here, it's these last 4 days that have been a bit worrisome. Starting from Friday, we saw rejection off of the 50 EMA. Again, we saw it on Tuesday. On Wednesday, we did manage to get a close just above. However, we were very quickly rejected off of the 20. And again, today, that close above the 50 was invalidated with a close below, and again, more rejection off of that 50 EMA. The other part that's concerning is this downward trending volume. So we're slowly starting to make our way up ever so slightly, but there's just not volume there. So all of that to me screams, look out, caution, we might be coming back down. Now, I do already have a few different call credit spreads on. The first one due to expire is February 27. That's up at this 701 level, and I've got a few at staggered expiry dates. But this hedge won't be an option. So firstly, look at what will my trigger be to know, okay, it's time to actually enter this hedge trade. That will be a close below this sort of 677 level here. Why this level? Because it's served as support over the last, well, ever since really October, but in particular for the last month. We hit it on the 20th of January, we hit it again on the 5th of Feb, and again twice just in the last 7 days. If we get a close below that, to me that signifies that the next move likely is down. It gets us out of this choppiness. The choppy is the hardest part to play, right? Once we've got a confirmed direction, either way, we can, adjust our trading accordingly. But it's this choppiness that becomes tricky. So if we get a close below, I will then be looking for downward movement, firstly to this sort of, call it 670 level, give or take, which is the low of the 17th of December. We had a bit of support through there as well. And then potentially all the way down to our 150 EMA, which is sitting at, call it sort of 644, 645. And worst case scenario, back down to these levels here around sort of the 650 mark. Now, how do I play it? Let's assume we get the close. What am I actually going to do? It's not going to be options. I'm not buying puts. I'll probably have a few different call credit spreads that I'll be putting on. Obviously, these will all be expiring worthless or reaching their full profit potential, so I'll put a few more on. But as far as what my larger hedge position will be, it'll be on the ticker SDS. Now, what's SDS? SDS is a 2 times leverage inverse of the S&P 500, of the SPY, which essentially means that for every 1% that the SPY drops, SDS will go up by 2%. Yes, there's rebalancing, there's a few other things to factor in. It's not always exact, but for the sake of what we're using this for, which is essentially a swing trade, that's how we will look at it, okay? So when we enter our trade, the first thing I want to talk you guys through is how to determine what the position of your trade should be. Because oftentimes when people are swing trading, they'll use a percentage of their overall portfolio. I'm prepared to put 5% into this trade, 10% into this trade, whatever it may be. But the problem with that is that it can do one of two things. It can increase your downside risk by too much, or it can limit your upside potential. So instead of looking at what's the percentage of my overall portfolio I want to put into each trade, I look at what's the percentage of my overall portfolio I'm prepared to risk on this trade. For me, it's 0.5%, which the account that I'll put this in is a $50,000 account. So that would be a $250 risk. That doesn't mean that the entire trade will be $250 because this isn't going to go to zero over the period of time I hold it. But we need to work out, well, what is my $250 risk? So I'm going to assume, just to help you work this out, we're going to use today's closing numbers, and I'm going to give you a stop loss position based on where we're trading today. But if I enter this trade, we'll more than likely be trading at around sort of $70. So these numbers will be adjusted according to where we're actually trading. But if we were doing this today, we would be purchasing the shares. I'll use the closing price here of $68.51. And then we need to figure out, well, where will our stop loss be? So I would set the stop loss at a close below this middle of the Bollinger Band, so the 20 moving average. And then I would give myself just a little bit of extra room just in case we gap, just in case my stop loss doesn't trigger, whatever might happen. So I would actually set my maximum loss down here. It's showing sort of 66.92. Let's call it 67 for round numbers' sake. So if we get out our calculator, what we're saying is that we would purchase our shares for $68.51 and we would sell them at 67 as our stop loss. So per share, I'm willing to risk $1.51. Okay. Now, if I'm willing to risk a total of $250 for the trade, how do I figure out how big the trade could be? Well, we take our $250 total risk, we divide it by our $1.51 risk per share. And what that tells us is that we could buy 165 shares. So if we bought 165 shares at $68.51 and we sold them at 67, we would lose $251 maximum risk. So that would essentially mean if we were to buy 165 shares at today's price, $68.51, we'd be looking at an $11,000 trade. Now, I actually might choose to just take that at 160 shares. To be quite fair, I would drop that down just to give a little bit of extra cushion. 68.51. So call it 10,900. I'd probably get that closer to 10,500, and I would be very happy with that position size, because even though this might look like a big position for the size of the account, the risk on it is only 250. Remember that. We're not risking that entire 10.5 because we're setting the stop loss and because we're going to actually follow through with getting out if that stop loss is triggered. Okay, so that's how we'll size the actual trade. Now, as far as what's the upside potential, what I'd be looking at, remember we said that by the time I get in, it's likely to be around $70. So my first look to exit, and remember, we're not actually trading to this chart. We're actually trading to the SPY chart. But so that I can get a rough idea, I'd be looking at this date candle here, the 17th of December, at around 72. And then the moving average would get us to around 70, call it 74. And then these days of the lows on the SPY, the 20th and the 21st, around, call it 75, 75.50, give or take. So that's my upside potential if the SPY drops. So coming back to the SPY, what am I looking at there? Remember, we'd be entering here and then we'd be writing that down to this first level, so the low of the 17th of December, and we're playing it based on this chart. So when we get to this level, what does the chart then look like? Does it look like we've probably still got some more downside to go? If so, then we hold on until we get to this sort of 664, 665 level. What are we looking like there? Again, we play it by ear. Now, this might be a trade that I stagger out of as well. You know, if we get to this level of 671, I might take some profit and then I might leave some more shares on the table. I might get to 665 and I might take out maybe 80% of the trade, depending on what we're looking like, right? And then if we start to get the reversal, then I'll take off the remainder of the trade. But that's how I like to play hedges. Um, the important part is, though, we need to wait for the confirmation, right? Either way, no matter what happens, we need to wait for the confirmation. So next week, we will either see, I believe, a confirmation to the downside, or we'll get some good closes above. But I kind of get the feeling that next week we hopefully end some of this choppiness because we've been stuck in this range for so long. It's the hardest kind of market to trade. If we've got a confirmation to the downside, we can trade that. If we've got a confirmation to the upside, we can trade that. But for now, we're just kind of sitting on our hands, waiting, placing just small trades. I want you guys to realize as well that no trade often is a trade. It's okay to wait because then when you wait and you get the confirmation, the chances of being right are greater. So you're actually ending up taking less risk for more upside by waiting. So I hope that that is helpful. Just to let you know as well, my mentorship will be reopening in March. So all of the details are in the description below. And this is just one of the kinds of things that we will cover in more detail. So for me, for my trading, for what I like to teach in mentorship, a lot of it is based around this: charts, market structure, knowing to spot when we get in, when we get out, because that's ultimately what, number one, protects our capital so that we can continue trading for the long term. But number two, helps us to get outsized returns because we're not guessing, we're not just crossing our fingers and hoping, we're taking calculated moves so that we get the most likelihood of success. So if you're interested in that, take a look in the description, and I hope to see you inside the mentorship.